McCulley is former chief economist at PIMCO and currently a senior fellow at Cornell University. Paul, it's great to have you here. We spoke with David Zervos yesterday, who was very disappointed in the Fed's communication over the past week and basically says they're the reason for the market sell-off ever since. What would you say about their communication techniques and style, including what we've heard from Powell and some of the other Fed members today?
Actually, I'd be on the other side of that trade. I haven't been disappointed, and I don't look at the market reaction as a fair gauge of what the Fed and Chair Powell is doing. I think they've been very clear in their communication is that a sustained recovery that reaches further and further into our citizenry requires a all-of-government approach. And the Fed is all in, unambiguously all in, but it simply can't do the job by itself. And the Fed needs some help from the fiscal authority. So I don't think there's anything new in the message that Jay's been giving to Congress is, Congress, do your job.
Although what's new is this average inflation targeting, where they're saying, yes, inflation can run above 2% before we tighten policy. And people want clarity on that. How far above 2%, for how long? That's what Charlie Evans gave some context to today with saying it could be 2.5% and so forth. Do they need to lay out a more specific framework, or at least say one is coming, or kind of talk more in that direction so that people understand what those benchmarks will be? Because otherwise they're probably going to default to, similar to what we've already lived through, which is, maybe 2% or just the projections getting us there and we tighten anyway.
I think Wall Street wants a formula. And I think the Fed is pushing back hard on the notion of giving out a formula. And Wall Street's just going to have to get used to that. I think what the Fed has said has been very, very clear, is before they will get off of zero, and that's the big issue that everyone wants to know, before they get off of zero, two things have to happen in this order. Number one, you have to get to maximum employment, which is not a particular unemployment rate, but a holistic assessment. Maximum employment is a necessary condition. And two, you have to be at least to 2% on inflation. And right now, that is the effort, is to get to maximum employment and get to 2% inflation. Wall Street wants to know what happens after that. And it's very hard to describe what happens after that because it's all path dependent. So I think the bottom line that you're getting from the Fed right now is focus on those two conditions: maximum employment, that's number one, and 2% or higher on inflation. And then we will start thinking about increasing interest rates. So the specificity that Wall Street wants, which has been accustomed to literally for the last decade, they're not going to get, because the Fed can't deliver specificity way out in the future. What it can do is focus on right now, be very articulate about what it wants to achieve, and be very strong in asking for help from Congress to effectively spend fiscal red ink into reflationary monetary wine.